Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Welcome to episode 110 of Carson's Facts versus Feelings. Ryan and Sonu. Sonu, we're titling this week, Will Higher Rates Break the Economy? That's pretty scary sounding. You put it like that. I don't know. Hope not.
And I've been pretty positive. We have to pick something that's on the, the risks. People always ask us, wait, are you guys perma bears? Do you see any risks at all? Mm-hmm. Yeah, sure, we see risks. And I think one of the biggest risks out there is, the fact that interest rates are, I will say, too high.
Mm-hmm. Yeah, I don't know if it was a Freudian slip, but you said, are we perma bears? We've never been. We have never been.
There you go. See,
no one's ever said, those Carson guys, they're perma bears. Not really.
Ouch, touche.
Yeah, that's all right.
Good catch.
Once a year I do something right. So there you go. So before we dive into it, this past Saturday, I drove up to the great city of Chicago, the Windy City. Wasn't all that, parts of it were windy. We were outside at Wrigley Field watching some football. Sonu, did you learn anything about American football? Because sometimes you don't always know all the rules. Is there anything you learned, and who do we see?
It's a party. What can I say? That's actually why I like American sports. I feel like American fans. I mean, don't get me wrong. I mean, you hate Michigan, so there's some intensity and passion around all of this stuff. But I feel like Americans sort of like move along, right? Like you move along after the Bengals, and I'm not a Bears fan, but I know a lot of Bears fans who move along. I feel like sports get really intense outside America, and that's like you live and die by that. I mean, metaphorically speaking, obviously. But over here, it's like, you move along with life, and it's a party. You go to the game for 3.5 hours. Your team wins, your team loses. All the Northwestern people near us, they were having a good time too, even though they got smoked.
Mm-hmm. Yeah, so we saw Ohio State Northwestern at Wrigley Field, and it was sort of close, then it wasn't. But I will say, like, you could tell people were partying. I mean, that Wrigleyville, I mean, it was very clear. Those bars opened up it was like an 11 o'clock game, Chicago time. You could tell the bars had opened up for a while. Yeah. We were joking. I've never stood up more for a game to let people sitting next to me. It was repeated.
Somebody almost pushed you down the rail. We were sitting right in front, up on the, it was like 3 levels up. So we had a really nice view just so that everybody was off the game. And sort of, we're sitting on one side of an end zone, basically. Just the way, it was interesting how they set Wrigley up. I mean, for any of you who've been to a ballpark, think of how a football, field fits into a ballpark. That's basically what happened. But it was fun. Ryan almost got pushed down by somebody who fell back with, I'll say a drink or two, but thankfully not.
It could have been really bad. Yeah, we were in the front row up top, and it was one of the 95 times the people around us were getting up to go buy more drinks and go to the bathroom. So I stood up, and then someone behind us somehow like just fell down the stairs and like bumped into me pretty hard. And I like kind of went forward and bumped up against the railing. I was like, man, if this guy hit me harder, I looked down, it had about 100 foot. We probably wouldn't be doing this podcast right now. But fortunately, that avoided catastrophe one more time. Use one of my 9 lives there. Yes. I don't know.
But your boys had a good time?
Yeah, the boys had fun. Long drive home. Boy, I was tired. That's a long 4.5, 5 hour drive home. But we made it, and it was fun hanging out in Chicago there, watching Ohio State win. And some big games coming up for a lot of schools as it pertains to college football, but we'll just end it right there. Sonu, so that was fun. But let's get into things. Definitely we want to focus on higher rates. We've got some higher yields, and maybe the Fed's not going to cut as much as they were. What does that mean? Should they be cutting? You've done a lot of work there. We'll talk. There's a lot of economic data last week. We were kind of kicking around what we wanted to talk about, and we realized, there was a ton of stuff to talk about from last week. But let's just start with the market. I mean, listen, it wasn't that long ago We're hitting all-time highs on the S&P. S&P has 51 all-time highs, up over 25% for the year. Last week, stocks can go down. We had the worst week in a while. That was on the heels of the best week all year. But when we looked at the headlines, right, the S&P down 2% last week. Hey, not that big a deal in the whole scheme of things. But I believe financials were higher, right?
Yeah.
Communication services were strong.
More than 1% last week.
Yeah, like some of those cyclical areas, energy did well. Now it's come back a little bit. I mean, when you look at that, I guess here's my question. I can ramble all day, and I do for a living. I ramble. A lot of that was because technology lagged by a wide margin. Applied Materials, not a recommendation, just fact. They had some disappointing earnings, disappointing news, stock down a lot. So tech was really weak Thursday and Friday. Other groups really weren't, honestly. You want to take it from there?
Yeah, I think that rotation is still on. I mean, it wasn't exactly risk off. I mean, a small cap stocks, which if you're thinking risk on or risk off, one of the first places you look at is small cap stocks. Small cap stocks are down more than large cap stocks, but they went up a lot, the week of the election, right? So there was some pullback. But interestingly enough, mid caps actually didn't go down as much as the S&P 500 did. So again, I think it was more rotation. And it's a good question. I was thinking about it today. Like, what if the Mag 7 and semiconductors and things like that don't drive, the overall index higher like they have done this year and maybe last year too? I want to make it clear that it's not the only reason the S&P 500 is up 25%. But, they've made a big chunk of the gains, right? I think you see what you're seeing now. It's like sectors like financials taking over. Maybe there's some consumer discretionary in there. I know Amazon and Tesla are a recommendation, but they're a big part of that. But you could see energy, financials, industrials is a big thing too. Notably, I think what really got hit last week was healthcare, right? But I think that had to do with, what's happening with, President-elect Trump picking maybe RFK Jr. as his Health and Human Services Secretary and things like that. And, there's a whole lot of noise. I'll say, and it is noise right now because we don't know what will happen. But we need to cut waste, fraud, and abuse from the system. I think nobody'd say they're against that, right? But then a lot of quote-unquote waste, fraud, and abuse is in government healthcare spending and maybe even defense. And hey, one person's waste, fraud, and abuse is a company's margins, right?
Did you just make that up? Have you ever said that before? That was good.
No, I just said that. So all that to say, I have to see it to believe it. We'll see what happens next week.
There's an old saying, I've used it on this podcast before, news trumps charts. And we had news, right? RFK going to come in and maybe shake up the healthcare system. I mean, that's what it is. The market was freaking out a little bit. Will he really? Will he not? Listen, tune in a couple of years. We'll see what happens. But biotech had one of its worst weeks ever. A lot of healthcare names. So again, healthcare is a group that we've toyed around with, honestly, for well over a year now. Carson Group, should we go overweight? Should we not? And I've continued to say, look at the relative strength of healthcare versus other groups, healthcare versus the S&P 500. It just kind of continued to slowly underperform, right? I like to see relative strength before I want to dip my toe. And it's kind of like catching a falling knife. It looks really cool, but usually you're going to cut yourself along the way. And healthcare has felt that way. So to see this underperformance out of healthcare recently, sure, it's unfortunate if you're overweight healthcare. We haven't been. It's a group we're more neutral. I want to be very clear. It's not wildly underweight healthcare here, but it isn't a group that I think it's time to go all in. Now, as this economic cycle ages, there's some more defensive areas in healthcare that make sense. But honestly, what have we said like a broken record? Financial's been our favorite group all year. Financial like 35% on the year, the top performing group, okay? It was utilities for the longest time, but financials overtook them. Industrials are probably our second favorite group. Those are cyclical areas. And in mid-cap, those three things together have been our three biggest overweights, and they've all done fairly well. Now, talk to me in a year. We'll see what happens. But we've been right, so to speak, with what comes to those. And honestly, I go on TV. A lot, whatever. I got a face for radio. What can I say? And I'm always like, we're neutral tech. I mean, you say neutral tech. People think that means you think it's going to crash like 2000, 2001, 2002. So no. Neutral means we manage money. We're not just going all in. We have a large percentage of the money we run in tech. You know why? Right. Because tech's like, 30% of the S&P 500. So when you start slicing and dicing, we have a lot of tech exposure.
And we like communication services too, which has your Googles and Facebooks of the world too. Again, not a recommendation.
And that's where I was going with that is is we actually have we've had a little bit of overweight on and off to communication services, not nearly as large as tech, but that's an area, again, where the valuations aren't quite as stretched. There is a little bit more relative strength. There's some positives. So, hey, we'll see how it all shakes out, but that's kind of where we are. But again, just want to be clear, just because you're neutral tech doesn't mean you don't like it. It's just, you know what, there's some other better areas out there, and that's what we continue to see. So let's see. So Sonu, almost Thanksgiving coming up, holidays tend to get strength. November tends to be strong, but the middle of this November, after the election kind of election hangover maybe, we have seen a little bit of weakness. And then you come in today, the day we're recording this, and all of a sudden Ukraine and Russia's back in the news with some worries over what's happening. We're no experts there. You guys see the same news that we do. You see things like that, and it gives you a little bit of pause. What do you think about the geopolitical concerns here?
I think that's, converting. I mean, we could talk a lot about that, and it'll all just be speculation.
Sure. Right.
It's spent probably 2 hours, and it may not amount to much. But
that sounds like most of our podcasts. Not teasing, though. No, our podcast's been pretty good. I'm teasing.
Where it actually amounts to something is, what does it matter? How does it translate or not into portfolios, right? Yeah. And I think that's ultimately why you want a diversified portfolio, right? You want diversified portfolios even within equities, right? Because you don't want to just bet on one sector or the other. And, our quote unquote bet is that will be broadening out. We've been talking about that for a long time, whether not just large caps, but into mid and small, but even within large caps into sectors like financials, things like that. But you also want, bonds have been a bad word for 2 years now, maybe 3 years, 3 years, right? So, but you want some bonds in your portfolio because, if the world goes to, hell in a handbasket, what's the safest asset? It's the dollar in U.S. Treasuries, right? So, and suddenly, and we saw that today. Today is a good example of that. Yields, we're going to talk about interest rates. Yeah. Interest rates have been going up despite the Fed cutting by about 75 basis points, 0.75 percentage points over the last couple of months, September and November. But yields have been going up. But today, when you had this geopolitical global risk, oh my God, the news headline was about nuclear stuff, right? Nuclear strikes and Russia. And suddenly what happened to Treasury interest rates? They went down. Right. So that's why you want that protection. And on the other side, we've talked about diversifies as well. We have things like managed futures in our portfolios. So if oil prices go up, it didn't today, but if it did, if there was some crisis in the Middle East, that's why you want to, you want some exposure to those parts of, the investment universe as well. So diversifiers, hold diversified portfolios. I think it's very bland advice, but I think that serves you well more often than not.
Well, some of the best investors in history have been rather bland. Just again, not chasing the shiny object, keeping a diversified portfolio, rebalancing, not getting too worked up over the scary headlines or even optimistic headlines, right? Chasing what's doing well. Yes. And those are tried and true things that have been discussed way before we started doing 110 of these podcasts, but we're always trying to remind people of those. So again, just a couple high level things on the market, then maybe we'll talk about the higher rates and what it all means. November is the best month of the year since 1950. It is the best month of the year in an election year. It is the best month of the year in the last 10 years and second best the last 20 years. So, we are still higher in November, had some weakness, obviously, last week. Again, big gain. So initially after the election, when you're up 17.5% for the year going into November, like we were this year, November's been higher 12 out of 14 times. All right. There's still some reasons, I think, if we get some indigestion here in the middle of November, which we're seeing, it's probably going to be fairly contained. It's probably going to be an opportunity. Again, we still expect there can be an end-of-year rally. That we're going to start talking about Santa Claus coming to town pretty soon, which is usually
what about Thanksgiving? December. What's the prognosis for Thanksgiving?
Oh, I'm going to eat way too much. I'm going to stuff myself. No. I know what you're going with.
That's a confident prediction right there.
Yeah, So I've been actually trying to eat a little healthier. By eating a little healthier probably means eating less, which is kind of a good way to do it. I've got a treadmill right over there. I've been doing a treadmill a lot. I got on the scale today, and I'm down like almost 13 pounds from October 1st. So
wow, good for you.
October 1st when I said, because I traveled a lot in August and September for work. And let's just be honest. When you're traveling for work, somebody else is paying. Everybody wants to go to the steakhouse. It just... it's tough. And I have not traveled as much lately.
Even when we're paying for ourselves, we had a good meal.
Exactly.
On Sunday, on Saturday.
We paid. I paid for food on Saturday, and I ate great. Yes. So when you're at home and you can kind of control it, I mean, I get it. Have more ability to control yourself. But listen, when you're on the road, we've all been there. So anyway, so I've been doing pretty good. So what I'm getting at is,
that's some bland advice for you. Eat what you want, but eat less of it.
Yeah, and just keep track of it. I've got the little app on my phone. I try to keep track of everything I'm eating, try to keep a certain calorie count. But anyway, so for Thanksgiving, I'm going to try to keep doing good, and then I'll just eat a whole bunch. But that's not what you were getting at. You were getting at around the stock market. And yes, historically around holidays, you get what? Light volume, you get light news, and in those situations, you get an upward bias. So late November definitely can be, or potentially can be, another strong period. I think that could be what we're looking at here. So, all right, so that was a good discussion, I think, of markets in general there. Let's talk again. This is episode 110. We titled it, Will Higher Rates Break the Economy? So let's just talk about it. The Fed, as you mentioned, they cut 25 basis points back in September, 50 basis points a couple weeks ago, like 2 days after the elections. Nobody even noticed. But they have cut 50 basis points, and surprising most of us, the 10-year yield soared from the time they started cutting. We talked about this last week, but
right?
Total 75 basis points. Yet yields around the globe, especially longer end of the curve, have gone higher. And listen, we are optimistic still, but there's always worries. Talk to me about why, if rates stay higher or continue to go higher, that really could be a hindrance to the economy in 2025.
No, and it's already turning into a hindrance for certain sectors of the economy, right? And especially the most cyclical sectors of the economy that are dependent on interest rates. What comes to mind first? Housing. Right? Look, when you're mortgage rates have done, have gone up a lot from 3.5% a few years ago, all the way up to 7-8%, almost 8%. But then beginning of this year, 2024, they started to pull back, and we saw some more housing activity. And then suddenly, you're like, wait a minute, the economy is growing stronger starting in mid-September. Ironically, it was literally the day of the Fed meeting. The Fed surprised everyone by going big and cutting by 50 basis points. I mean, you and I have argued that they should have gone in July, in which case they wouldn't have had to go big in September. But it is what it is. That's the way things shook out. But interest rates, the 10-year Treasury interest rates has gone up about 60, 70 basis points since September, over the last 8 weeks. That's a big move, right? And what does that do to mortgage rates? I mean, look, mortgage rates are keyed off 10-year interest rates, and that's mostly because most people tend to stay in their homes for about 10 years, right? And then there's a spread on top of that. The spread is basically a premium applied to, what people, there's some credit risk there. I think that's probably a good way to think about it, right? There are other factors also that go into it, like supply and demand. Right now, there's not a lot of housing activity. So because of that, when your loan officer gives you a mortgage, he's like, you know what? I don't have a lot of activity, so I want to collect a little more premium over that 10-year rate. So that spread is higher too. It's higher than it has been historically. Mortgage rates have gone back up to 7%. You combine high mortgage rates, home prices have been rising, which is great for 66% of American households that own homes, but not for the folks who are looking for a home, because that means affordability is crashed, right? So you don't have affordability. You have low, housing activity. This morning we got housing starts permits. That's down again, both on the single family side and multifamily side, right? So what builders are doing is they're just focused on completing homes. They're not focused on starting new homes. I think eventually that's a supply problem, maybe for 2026, 2027. But yeah, housing is a problem now. The good news is construction jobs, right? You look at construction jobs. I was looking at this, going back into history. They almost always, if construction jobs start to fall, that sort of foreshadows recessions. It foreshadows,
makes sense.
Weakness in other parts of the labor market as well. We haven't seen that yet. Even in 2022, for that matter, when you and I were talking about there's no recession, things like that, everyone else is like, yes, there will be a recession. Bloomberg was like 100% chance of a recession. Construction jobs actually didn't fall. They just kept going up, up, and up through 2022, 2023, and into 2024. But I think now what the risk here is, because rates are so high, you could start seeing construction jobs flatten out, maybe go negative. Hopefully it doesn't go, into reverse. But essentially it comes back to the fact that rates are too high. The Fed needs to cut more. and they need to give some guidance that they are going to cut more, sort of maybe even surprise markets, right? And tell them we are going to stay on this path of cutting rates, instead of being spooked by, oh, CPI came out, that's okay. PPI comes out, that's a little hot. Maybe we shouldn't cut. No, don't do that, right? Just I think they shouldn't be data point dependent. They should be data dependent. Everything we're looking at on the inflation side, especially forward-looking measures of inflation. I think one thing is the data that comes out, whether it's CPI, PPI, PCE index, whatever, right? It's all backward-looking stuff. And then the backward-looking stuff also has lags, like shelter, which means you're really looking at stuff that happened in 2021 and 2022. The forward-looking stuff, inflation expectations, whether it's consumer expectations, business expectations, market expectations, all of that tells you that inflation's normalized. I think the Fed should just go with that.
Yeah, so we're going to get into some of those things you just talked about a little more, but I do want to talk about the city of Dallas, because that is where Jerome Powell was last week and made some comments that we'll dive into. But also Mike Tyson fought Jake Paul in Dallas last week. Did you have the opportunity to watch that? I know it was a difficult situation. Yes, yes.
I couldn't get onto my Netflix. Yeah. So I ended up watching another show that I recently got into the show called, not Tangent, but something called Slow Horses on Apple TV.
Okay.
It's really good. Kind of a thriller, British show about spies at MI5. So I definitely recommend. It's a good one.
Okay, that's good. No, that was the night we drove into Chicago, and my boys and I were all, like the rest of the country, were trying to log into Netflix and watch this fight. But you know how I finally ended up watching it? Somebody was streaming it on X. So I couldn't make it work, but it's right there on X. Someone was streaming it. I saw, there we go. So I watched the fight on X. How about that? You could argue.
Was it exciting?
The first round, but boy, it was clear Tyson. I mean, listen. I enjoyed watching Mike Tyson as much as the next person out there, but 58 years old, father time does catch up. But you know what? Like he said, he lasted every round. He didn't get knocked down. He kept fighting, but I think it was clear Jake Paul probably took it a tad easy on him. They didn't really want to embarrass him. But hey, they all made a lot of money, and
I bet they made a pretty penny with that. I'm sure.
Exactly. So back to the city of Dallas. Jerome Powell was there. I believe it was on Thursday of last week. Sonu, was it Thursday?
Last week.
Yeah, that's when the market started getting weak, Thursday and Friday. But the applied materials had a big deal with the weakness on Friday with tech. But anyway, quote unquote, not in a hurry to cut interest rates. A couple other things here. I've got to summarize it. He said the economy is not sending signals that we need to be in a big hurry to lower rates. He pointed out the economy is strong, though, a couple different times, too. And again, last thing, I'll turn it to you. The odds of no cut before he started talking was 17.5%. The odds after he was done talking went up to 39%. I'm not exactly sure where they are now, but clearly that shook the apple cart a little bit and kind of led to the higher yields and the realization, oh my goodness, the Fed's not going to cut now, along with that inflation data, which we'll dive into next. What's your take on what the Fed, what Jerome Powell said in Dallas last week?
Not good. I mean, I wasn't nothing as simple as that. I was very confused. I'll put it that way. And especially because I'll use the same analogy. The apple cart is rolling along fine because we got CPI data on the day before he spoke, I think. So that was Wednesday of last week. And CPI was slightly on the harder side, but people are looking through all those weird places where, like shelter, right?
CPI is a consumer, right?
Consumer Price Index, yes. The Consumer Price Index, that came out at, over the last 12 months, it's up 2.6%. But all that excess inflation, that's 0.6% above the Fed's 2% target, is entirely coming from shelter. Shout out to our friends at Wisdom Tree. They recreated the CPI basket, but they put in real-time measures, the shelter, as opposed to the Bureau of Labor Statistics measure of shelter, which, is still showing stuff that happened 2 years ago, right? But you look at what Wisdom Tree did, headline CPI, headline Consumer Price Index, with real-time measures of shelter, that's up 1.3% year over year. Official data is 2.6. Core CPI, take out food and energy, that's running at 1.8% if you include real-time measures of shelter. Official data is 3.3%. That's what when we say inflation is normalized, there you go. Inflation's normalized. So that data came out. The market was like, okay, this is no surprises, no upside surprises, no downside surprises. And the probability of a rate cut in December went up to about 80%. That's what you were talking about. 80, 81%, 19% odds of, no cut, right? But then the next morning, PPI actually came out, and the Fed's preferred. I know we've done this before, so I feel like I need to do it again. So the Fed's preferred metric of inflation is the personal consumption expenditures index. A little different from CPI. It doesn't have a big weight in shelter. It's still about 17%. CPI has about 34% in shelter. But a lot of the inputs for the PCE index, which the Fed prefers, comes from PPI, the producer price index. And some of those components are hot. Airfares are hot. Healthcare services are hot. What was really hot was portfolio management services. Why? Because stock prices are higher, right? It gets to that. Is that inflation? I don't know. I mean, I want stock prices to go up.
Yeah, I mean, let's be clear. Stocks are up 20% 2 years in a row. So the fee you're going to pay to your financial advisor, your institution, if they're based on AUM, is more, right? And when you have stocks soaring, I guess let's hope we're complaining about that in a year, because I mean, stocks continue to go up. We probably aren't up another 25% this time next year. Let's just be honest. So maybe that's, again, a kind of a one-off is what you're getting at, right?
No, exactly, right? I mean, could we see another 25% gain in 2025? I mean, hopefully, but I don't think we will. No, it's unlikely, right? Without giving away our outlook here. I mean, we're not bearish, so I'll just put it that way. Right. But look, so the PPI came in slightly on the harder side, like, maybe the Fed's preferred metric, core PC, is going to be on the harder side. The market actually looked through that. It was okay. Then Powell came in. Powell was like, the Fed need not be in a hurry to lower rates.
Right.
He said the labor market is still in a solid condition, and it's back to normal levels consistent with our employment mandate. So here I'm thinking inflation's normalized. The labor market is consistent with the employment mandate. So why is policy so tight? And then on top of that, he says the labor market's cooled enough that it's no longer a source of inflationary pressure, which means that's essentially a forward-looking way of thinking about the inflation outlook. He's saying wage growth has eased, so there's no demand pressure coming from the labor market. And he went on to say, we don't want the labor market to cool further. So I'm like, wait, you're trying to have it both ways. Like, things are solid, but you don't want it to cool further. So you're in the business of risk management. Why not, ease rates? Because certain sectors of the economy are hurting. The Fed has to be forward looking. It cannot be like, things are solid now, so we're going to stand pat, right? I think I was a little confused about this. And that's why I think the post-Powell odds of a rate cut in December went down to about, I'm looking at my screen, it's about 59% now, right? 41% odds of no cut.
Okay. And obviously we'd be in the camp that they should be cutting, as we've just laid out. I did also find it interesting. Powell, remember when they did the rate cut 2 days after the election, we knew the results of the election. People asked him a couple times, you going to stay on? You going to stay on? And he got a little testy, because let's be honest, I'm going to assume he and President
up
Trump,
a little bit.
Yeah, he and President Trump maybe don't like each other all that much. They both said some things, or maybe more President Trump said some things about him. But he's got to be careful what he says, I guess. But listen, it is what it is. And he made the comment then, that he wasn't going anywhere, right? The Wolf of Wall Street, not going anywhere. Think of that little phrase or meme. He did say recently last week, he will stay on until May of 26. I wasn't 100% sure when his term was up. I know he started February of 18, right? February 4th of 18. That was the first day Powell ever took office or took charge of the Fed. The Dow dropped 4.6%. The worst first day for a Fed chairperson ever. Was it because Powell started? No. That was the day. That's bad first day on the job, by the way, though. We've all had a bad first day of the job. If the Dow going down 4.6% your first day, pretty bad for Powell. That was when the trade war started. That was when they slapped on. That was when they, as the expression, slapped on a tariff on washing machines out of China, and away we go. But that was Powell's first day. But anyway, so Powell officially he says he's sticking around until May of 26, and then he'll probably say, hey, I've had a pretty good legacy, 100-year pandemic. We got through the other side. Was it perfect? No. We've got some issues with what the Fed did here and there. We all probably do. But overall,
and I'm leaving before I get fired.
And leave it, and exactly before I get fired. True. And like I say, greatest handoffs ever. The greatest handoff ever was Volcker, right? All 6'7", Paul Volcker. He handed things off like middle of August, I think August 15th. But anyway, around August of 87, when the S&P was up 40% for the year, 500% the previous 5 years. He probably knew what was about to happen. He said, "Here, Greenspan, you're it." 2 months later, boom, 87 crashed. So that was a great handoff. So I don't know if we're gonna have another good handoff. Just know midterm years tend to be a little rocky. The first 6 months of a new Fed chairperson tend to be a little rocky. So just be aware, 2026 is out there looming. We're pretty optimistic 2025 still. I don't know. Maybe by the time we get to 2026, might have to reevaluate some things with new Fed leadership and some different things taking place. Anyway, what else? Oh, one other thing. You hinted at this, or you talked about it. I want to point it out. Assuming I can find it. I had it here somewhere.
I forget now.
No, it was inflation expectations. I know I've got it. I mean, I literally have it here.
Oh, yeah.
Turn this page.
Consumer expectations.
And I've got the exact. Here we go. So the other thing Powell said, a year and a half ago was before he really started cutting interest rates, or last year as well, he wanted to see expectations of inflation come back. Because if you look back at the surveys, we don't know how accurate they were in the 70s, but it is what it is. In the 70s, people did not expect inflation to come back. Almost like a self-fulfilling prophecy. Powell said, I want to see inflation expectations come back before I start to cut. Well, they've cut twice, and we're seeing that. But just last month, so the data just came out. University of Michigan, expectations on inflation 1 year out, lowest since November of 20. The New York Fed has a consumer inflation survey they do. That 1 year inflation expectations lowest since October of 20. So it's two different sources with a ballpark the same time frame. The lowest expectations on inflation in a long time. Why is that a good sign? Why is it that lowered expectations on inflation matter to what the Fed is doing?
Two things. The way the Fed sees it, I'm not sure I completely buy into this, but what I buy into doesn't matter here. It's what the Fed buys into. It's a thing, right? So, it doesn't count what I buy into or what I think should happen. But look, the way the Fed sees it, the inflation expectations, if people expect your prices to go up, say 5%, then what they do, is go and ask the employers for a 5% increase in wages, right? Mm-hmm. And that's the theory. And then if they get a 5% increase in wages, they have more money. They're going to continue spending on stuff. And then we have that, that's going to push up prices. There's this feedback loop, right?
Yep.
Negative feedback loop. I mean, you and I will be happy with a 5% increase in our wages and our salary as opposed to a 2%. But the Fed's not going to be happy about that, right? So that's the whole idea of inflation expectations. But for me, the bigger thing with consumer expectations is, look, if if the BLS or the New York Fed or University of Michigan called us and said, Sonu, Ryan, how much do you expect inflation for the next year? I don't know. I mean, I do this for a job, and
I'm hanging up. I don't give any answers. I don't know. Like you graduate from a college, they call you asking for money. It's like email me. I don't like talking about this.
What are you going to answer, right? So, but of course, these folks have been doing this for a while. Usually, the way they answer is they just say, "Oh, inflation right now is 3% or 10% if it is back in 2022. I think that's what it's going to be over the next year." People project current inflation into the future, especially consumers. But I think everyone, even markets and businesses do as well. So when consumer inflation expectations is around 2.9%, and by the way, that's similar to what was there before the pandemic from the New York Fed survey, that's basically telling me that current inflation has normalized.
Yeah.
That's the story there. You look at business expectations, that's running about 2.2%. The Atlanta Fed has a survey that asks businesses, what do you think for future inflation will be? You think businesses are a little more informed about, than consumers are about this stuff because they're thinking about future prices and input prices, things like that. And then you look at market expectations, wisdom of the crowds, right? Market expectations for future inflation, whether you look at the next 5 years, next 10 years, whatever it is, it's all consistent with 2% target inflation. So and this is the stuff you want to look at as opposed to CPI, PPI, PCE, which is all backward stuff. This, expectations is what you want to look at, when you're thinking about, okay, what is the outlook? What's the outlook for future inflation, right? So, and right now, I don't know how many which ways I can say it. Outlook looks good.
Yeah, a couple other things on inflation. I think we've beat this dead horse into the ground. Apartment list year-over-year prices on rents. So they look at rent prices. That's real-time rent data. Now it's apartment list data, but still pretty big database. Negative year-over-year 17 months in a row. That's a lot. Okay. And again, the real-time rent data here in the U.S. is like ballpark 5% or so. Wisdom Tree said real-time, shelters like 1.3%. The government saying close to 5%. Listen, it is what it is there. Also, though, food at home, that's groceries, was up, I'm going to say air quotes only 0.1% last month, only 1.1% year over year. Yes, groceries are a lot more than they were 4 years ago. Groceries are a lot more than they were 3 years ago. Groceries are a lot more than they were 2 years ago. And we understand at, we get it. But what the market's looking at, what the Fed's looking at, what we're looking at is these year-over-year, month-over-month changes. They're drastically coming back in line. And then food away from home. So think restaurants, right? Up 3.8% year over year. Well, that sounds kind of like a lot. Then you realize it peaked at 9 not that long ago, and that's the lowest this cycle. So that also is coming back down.
That's similar to what we saw in 2018, by the way. 3.7, 3.8%.
Right. So anyway, I think we've hammered inflation as much as we possibly need to. We maybe. I mean, we probably want to go.
The Fed should
go ahead.
Cut, right? I mean, that gets back to the title of the episode. What's the Fed sitting and waiting for? I think they have, and this is one of the opportunities for next year. We're going to write about this in our outlook, right? Probably in the process of writing right now. I think the economy is stronger, like has a lot of strengths, which overcome the weaknesses like housing and things like that.
Yep.
It's a risk, but I think, there's enough strength, right? Incomes are strong, productivity is strong, but the productivity piece is important, right? And here's where I think the Powell-led Fed has an opportunity to do what the Greenspan Fed did in 1995.
Yeah.
Greenspan in 95 saw that, okay, inflation's still a little elevated, but I'm going to bet on productivity growth being strong, and that's going to keep inflation muted. I'm going to cut rates. I think the Powell Fed has an opportunity to do that in 2025. Will they? I don't know. I think they will. I think on balance, the odds are that they will, but it's not 100% probability right now.
Yeah, and the other thing about the mid to late 90s, you mentioned higher productivity. They could cut. Higher productivity can put a cap on inflation in an easiest sense, the way to put it. Wages actually stayed higher back then. So it sounds like this perfect scenario of higher wages, contained inflation, and you can cut interest rates. Well, listen, the last time we saw multiple years in a row of 20% gains was when? The mid to late 90s. We're looking at it right now with some history to repeat itself. It often rhymes. Mark Twain. I mean, Sonu, you've been all over this higher productivity theme for 18 months now, 2 years now, it feels like. And it's been playing out the last 6 quarters, and we think it very well could continue. So we're at the top of the hour. I know it doesn't matter to people listening to us, but ballpark is when we wanted to start. I mean, we actually wanted to talk about some of the economic data last week. Is there a quick version? Retail sales, industrial production. Can you sum it up in a couple minutes? We probably would have spent 10 minutes on it, but we get wordy. What'd you think on retail sales and industrial production last week?
Retail sales was strong. I mean, vehicle sales was strong. Restaurant bar sales, we just talked about that. Restaurant bar sales also.
Yeah, we helped that one in Chicago. We did our best.
Last 3 months, restaurant and bar sales are up 10%. Right. Okay. Now there is the core group, what we call control group is jargon, right? For retail sales. That's the stuff that goes into GDP. That fell 0.1% in October. But look, over the last 3 months, it's running about 3.5%, 4%, 3.6% to be perfect. That's still a strong trend. By the way, goods prices are falling. So that 3.6% is nominal, but it's also close to real inflation adjusted terms because goods prices are more or less flat, maybe even slightly negative year over year, right? So that's a solid pace of consumption. Just connecting that to this morning, we got Walmart's earnings.
Yeah,
Walmart's same store comparative sales were up like 5-6%, the best in 6 quarters. That tells us. I mean, Walmart's always mixed.
Oh, you knew where I was going with this. Yeah.
As our friend Sam Rowe also likes to remind us all the time, like, it does strengthen Walmart means the consumer's weak and they're spending more there? Or does strength mean actual strength for consumer? No, I think it's clear. The consumer's strong. I mean, they talked about, wealthier consumers trading down. But even if you adjust for that, right, the low end of the income spectrum, you're talking about, 0 to 40th percentile by income, households in that range. A lot of them shop at Walmart. And the fact that Walmart sales is strong tells you income growth for that cohort is pretty strong as well.
Well said there. The headline CPI, no, wrong thing. So you talk about CPI. The headline retail sales from last month of September was 0.4, revised up to 0.8. If you look at X Auto, it was 0.5, revised up to 1%. And lastly, the control group was 0.7, revised up to 1.2. So listen, the headline numbers this most recent month were what they are, but the worth they were. The month before got revised higher big time. So, there's some good. It's kind of anything market. You can pick and choose what you want. You can find some good news, you can find some bad news.
3 months. Yeah, absolutely.
Yeah.
Right.
And that leads us to the industrial production. That was a little on the weak side, but listen, we just had the huge Boeing strike. You gave a stat that I thought was amazing. Boeing only made 14 planes last month, like the lowest they've done in a long, long time. They had a strike.
The lowest in 4 years, yeah.
Yeah, 2 terrible hurricanes go through. By the way, we did see used car prices jump pretty big last month. And again, a lot of people unfortunately lost their cars with the terrible hurricanes that went through. So there were some purchasing there. But, I guess still the hurricanes playing into the strike. So it's tough to say industrial production is weak because there's logical reasons it was weak, right?
Right. Yeah. No, exactly. Because of the strikes and hurricanes. Now, I would say, again, going back to the title of the episodes, right? Higher rates. I think on balance, higher rates are being felt over here since over the last 2 years, maybe in 2.5 years. Manufacturing has been flat. It's not been negative.
Right, but flat.
But it's been flat, right? And ideally, you want to look, manufacturing jobs pay a lot more than regular service jobs. So you want that sector of the economy to do well. I think it's being weighed down by higher rates, to be honest. I mean, even investment spending, right? I think part of it is, the other thing higher interest rates are doing is pushing up the dollar, right? Yeah. And if you have a more, pricey dollar strength, look, that's not good for U.S. manufacturing exporters because that makes, stronger dollar makes our goods more expensive, makes foreign goods cheaper, right? So that's where I think a stronger dollar, higher interest rates doesn't help. I think the Fed cutting could also help that piece of things. Now, there are bright spots in industrial production, high-tech equipment production. It's up about 10% over the last 3 months. Annualized pace, it's up about 8% over the last year since December 2019. I was looking at my notes. It's up 35%. By the way, that's inflation adjusted because you're measuring volumes, right?
Yeah.
Up 35% high-tech equipment production. We're talking about semiconductor chips, communication equipments, computers, electronics, things like that, right? And then battery production, right? This gets back to the CHIPS Act, IRA, all of that. That's up almost 50% since December 2019. That's huge. So there are bright spots there. And then there's defense production, which is also close to up, 10% positive over the last few months. So that's running. So there are pieces of the manufacturing sector where things are going well. But overall, excluding these 3 areas, high-tech equipment production, EV batteries, things like that, and defense, I think rates are having a negative impact. But that's an opportunity, like I said, for next year. The Fed cuts, and we could see a pickup here.
No, well said. Great summary there, and probably some cliff notes to how we see the world playing out next year on our outlook.
There you go.
So if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. And there's some algorithms out there that if you can help us there, those things do go a long way. Sonu, do you want to talk about where you're going next week, or keep it quiet?
Yeah, no. I will be out in India. I'm heading there in 2 days.
No, by the time people listen to this, Sonu's on a plane for 22 hours. So
yeah, I think door to door, it's going to be like 27 hours or something.
Oh.
Including like you go to the airport early and then, I land in Bangalore around in South India, but 5:30 in the morning, and then there's immigration, customs. You get out, take a cab to my friend's place. That's going to take it. It'll be 2 hours by the time I get there. So 28 hours door to door. I mean, so it's brutal. And then same thing on the way back, right? So. But I'm looking forward to it. I'll be out for Thanksgiving, and you guys hopefully will hold down the fort. You have special guests next week, right?
Yeah, hopefully Barry Gilbert on our team will fill in. We'll do like a what are we thankful for type of deal. But I was going to make a joke. As long as you have internet, you can always count the construction jobs. I mean, that'll give you something to do. That's something only you would like to do.
Next week is a busy week for data.
Yeah, you're missing. Oh, I know you. You'll still be watching. You'll be watching. And then here's the joke. Don't invest in this, but the last time Sonu was kind of out for an extended period of time was like early August. Okay, he took a sabbatical. That was when the whole world went nuts with the yen carry trade. So please, Sonu, try to keep things calm next week.
August is supposed to be a low volume time, and you literally just said Thanksgiving week is supposed to be low volume, and now I'm bracing myself.
Let's hope it stays calm. So anyway, with all that, everybody, thank you for listening to episode 110 of Carson's Facts versus Feelings. Will higher rates break the economy? Like we said, Sonu, safe travels. Everybody, holidays are coming. Thanksgiving is here, so have a good holiday week if you don't listen to us next week. But hopefully you do, because we'll be here. So with all that again, what else do we want to say? I guess, we'll just say we're signing off, right? Just enjoy.
Happy Thanksgiving for
happy Thanksgiving.
I know you guys will be on next week, but
we'll be on next week. There you go. So with that, everybody, take care. We'll talk real soon. See ya. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.